Hello guys, it's Amphyfx here. So today I'm going to be talking about SMC, smart money concept, so what it is, um, what or like everything it entails, from what you should know, and how you can also become a an SMC trader, and the things you should not take note of if you want to be regarded as what as an SMC trader. So guys, let's dive in. So smart money or SMC, smart money concept is what is a trading approach that focuses on understanding how big players, that is the banks, the institutions, the hedge funds move the market. That is how the smart guys, trade in the market. So we have two type of traders. We have the retail traders and we have the what SMC traders. Now, the retail traders is the general traders, those who trade simple support and resistance. We call them the what the retail traders. And then we have the smart guys. That's the SMC guys. I'm one of them too because I also trade what I also use the SMC concept. So SMC is what just like I said, is a trading approach. We treat like the big guys, like the banks, the institutions, and the smart guys. So if you want to be regarded as an SMC trader or you want to know what SMC entails, these are the things you should take note of. You should take note of what market structure, your liquidity, and your other blocks, your imbalances and what and your fair value gap. So market structure basically is how the market moves. It includes what an uptrend, and in an uptrend, market is making series of what higher highs, higher lows, higher highs, higher lows, higher highs. That's an uptrend. And then in a ranging market, market will be what moving sideways, so you either would stay within this range or you would stay out of the market. So market is not making series of higher highs or higher lows, but instead it's just moving sideways between what? Between two levels, support and resistance levels. So the retail trader love this kind of movement because they take advantage of either the breakouts or what bounce and what retest. And then we have the downtrend. In the downtrend, market will be making series of lower lows, lower highs, lower lows, lower highs, lower lows, lower highs, and then lower lows, right? That's in the downtrend. So this thing makes up what is also what a part of an SMC. If you want to be an SMC trader, you have to know what your what is market structure. And market structure basically, as I said, is what it's how the market moves, either an uptrend, ranging market, or a downtrend, or what market giving you series of higher highs, higher lows, higher highs, higher lows, higher highs, breaking structure to the upside or breaking structure to the downside. So in an uptrend, the highs are what? The highs are targeted and the lows are what? The lows are protected. And in the downtrend, the highs are what's protected and the lows are what? The lows are targeted. And in ranging markets, there is no highs and there are no lows. Instead, market is just moving between what? Between two support level, between two levels. That's the support and the resistance level. That's that for market structure. And then liquidity. Liquidity is what? Money or where money is in the market. So this level you are seeing, there are liquidities above this zone. Why is it that why is there liquidity? Because many retail traders are what placing their buy order in case market break above this zone. We call it the breakout traders, right? So means what they have their order place here, and we also have those who are what looking for market to touch this zone and begin to sell. And what do you think will happen? They have their stop loss above this zone, right? And then we also have those who wait for breakout and then the retest and what and then the bounce up. We also have their order here. And so this level, we can call this level what a liquidity zone. You can identify it as what as dollar symbol. So there is liquidity here and there's also what liquidity here. So also there is also liquidity here. That's your swing levels, your swing highs, your swing lows. There is liquidity here, there is liquidity here, there is liquidity here, there is liquidity here. There is liquidity here, there is liquidity here, there is liquidity here, there is liquidity here. Practically, markets always give you an hint where there is where there is liquidity in the market. So let me list the places where you can find these liquidities. Your swing points, that's your swing high or your swing low. your equal highs or lows, your your support and resistance levels, and then session highs and lows. So these are the what? These are the points where you can find what your liquidity sitting. So wherever you see these things, just know that what there is liquidity here, and you should what? What should you do? Always wait for that sweep of liquidity before you should what, look for your entry. But if you don't wait for the sweep of liquidity, you might end up being the what? Being the liquidity in the market. So that's that for liquidity. And then we have the other blocks or OB. We call it OB. This is where institutions place their odds, their buy or sell orders. There are two types of order block. We have the bullish order block, which referred to as what? As a demand zone. And then we have the bearish order block, which refers to as what? As a supply zone. The bullish order block is always at what? It's always at the bottom. That's what a demand zone. And then the bearish order block, that's what where institutions place their sell orders, and we call it what a supply zone. Just like the demand zones is where institutions place their buy orders. We call it demand zone or the bullish order block. And then for a supply zone, we call it what the bearish order block, where institutions place their sell orders. And it's basically what? It's basically the last candlestick before an impulsive move. So and then we have the next thing is what is an imbalance or a fair value gaps. So imbalance is basically what the impulsive move after an order block. This impulsive move you are seeing is what we call as what imbalance. And then the fair value gap is what the gap between the order block and the candlestick adjacent to the order block. There's what you see a gap between what the order block and the candlestick adjacent to it. We call it what we call it the fair value gap. Now let me show you this on the real life chart. So everything I explained, I said we have um what we have. We have market structure. Now market structure basically see this market we know structure is what? The structure is an uptrend, giving a series of higher highs, higher lows, higher highs, higher lows, higher highs, higher lows. Right? So what do you see? And then the next thing is what liquidity. There's liquidity here. We have what? Engineer liquidity here. Right? So we know there is liquidity here. There's liquidity here, there's liquidity here, there's liquidity here. So we've identified our liquidity. And then the next thing is what? Order block. The other block I said is the last candlestick before an impulsive move. Now this is the last candlestick, right? Here is the last candlestick. And then this gap you are seeing, this huge move is what we call an impulsive move. That or imbalance, right? Is what we call an imbalance. And then the gap, this same gap you are seeing, then the gap this candlestick is what? Or this move entirely is imbalance. But then the gap is in between the other block from weak high to weak low is what? Is the FVG. This gap we are seeing is what refers to as what? As a fair value gap. So as an SMC trader, you should always what? Know your market structure. Know your market structure, that's what? That's uptrend. Either the market is an uptrend. When it is an uptrend, it will be giving you a series of higher highs, higher lows, higher highs, higher lows. And if it is ranging, you either stay out of the market or you intend to stay within the range. And then we have the downtrend. In the downtrend, market will give you a series of lower lows, lower highs, lower lows, lower highs, and lower lows. And then the next thing you should identify is what? Know how to identify your liquidity. And I said liquidity, you can find liquidity around these levels, right? Your swing points, that's your swing high, either your swing high or your swing low. Then equal highs or equal lows. And then we have what? Your support levels, that's your support and resistance level. Then we have session highs and session lows. And that's that. Now let's look for another example. Now have a look at this. First thing I said is what? Is your market structure. Looking at the structure, clearly the market is what? The market is bullish, giving us series of high highs, high lows, high highs, high lows, high lows. higher highs, higher lows, right? The next thing is what is liquidity. Here is what is liquidity. There's liquidity here. There's what we call an inducement. Inducement is also refers to as what? Also refers to as a liquidity zone. Inducement is meant to what? Just as the name implies, it's meant to induce traders into what? Luring them into entry a position or to cause FOMO. Most traders are not patient enough and they will join on that first what? On that first thing because they think maybe market is not going to come back to their other block. And what this market did, market came back to what? To the other block, right? So this is what we call inducement, right? Or your liquidity zone. And then the last thing is what? Last thing is imbalance. Now this huge candlestick you're seeing is what we call imbalance, or in fact this entire one is what we call imbalance. And then FEG, the gap between what? Between the other block from the weeks to weeks, right? This gap is what refers to as what? It's what refers to as a fair value gap. And what do you see market did? Market came back, tap into another block and then begin to what? Begin to go towards the intended direction. So that's the essence of what. Now this is just a basic crash, uh, basic crash video on SMC. There is more to it, and like there are so much to it. There are so many things to this, not just what I explained, and that will take much of our time. So I won't be able to like explain them in this video. If you want to learn more and if you want to like get answers to your questions, you can join my mentorship. Check the link in the description below. You can message me directly on WhatsApp, or yeah, message me directly on WhatsApp, or join my free WhatsApp group in case you're not ready for the mentorship yet. It's all about it's all about value. And if this is your first time coming to the YouTube channel, please don't forget to like this video if you learn something, and share it with your friends, and subscribe, guys. See you in my next video, guys. Peace out.